So it is a great honor for me to introduce Chuck Schwab and Tobin McDaniel. Really, one of the highest honors of my life is being the Charles Schwab Professor of Economics, which I've been since 1992. And just after becoming the Charles Schwab Professor, I joined the Schwab Financial Services Advisory Council. And this involved quarterly, or maybe every 6 weeks, we were talking about this, a series of brainstorming sessions with Chuck and his team about the future of financial services. The other council members were Michael Boskin and Bill Sharp, and it was great fun. And in those meetings, I got to see what was really special about Chuck Schwab. He is not only intellectually curious, but he's extremely and extraordinarily imaginative. He is the originator of many of the ideas that have made his company so successful, and he loves to discuss and consider ideas from others. Over and over again, he has peered into the future and changed the financial services landscape. He did it from the beginning with discount brokerage, starting the firm in the early 1970s and growing it so that today it oversees $2.5 trillion for 9 million investors. One source, the mutual fund supermarket, was another of his really revolutionary ideas. He was key in extending indexed investing beyond the S&P 500. The company was always either the innovator in the field or a very fast follower, following each new development in financial services. At the time of our brainstorming sessions, we were thinking about such things as tax-efficient mutual funds, about online computer trading, which was very futuristic in the early 1990s. And I remember that the company was spending lots of money on facilitating computer trading, and Chuck was very impatient for the future to arrive. We were talking about fundamental tax reform, which actually needs further discussion today, and we were thinking about things that had quite a bit in common with exchange-traded funds, which didn't exist at the time, but which today are a huge part of the mutual fund market. The two traits that Chuck Schwab always had above all others were integrity and innovation. He always wanted to help those with modest financial means. Of course, Chuck is a graduate of the Stanford Department of Economics and the Stanford Business School, and is a member of the SIEPR Advisory Board, and we're all proud of our friend and former student. Having Tobin McDaniel here to join Chuck is absolutely natural, as Tobin is heading one of Schwab's newest innovations. Tobin McDaniel is the president of Schwab Wealth Investment Advisory, which has as one of its runs the Schwab Intelligent Portfolios. This is Schwab's entry into the relatively new field of so-called robo-investment advising. He'll tell you later that when you're thinking about the price of such a service, it's hard to beat free. It is the kind of offering that the Advisory Council 20 years ago would have talked about and endorsed, and if only we had a better vision 20 years into the future, maybe we would have even foreseen it. Before taking this role, Tobin was Chuck's chief of staff, and before that he worked for Nationwide Insurance and McKinsey. His undergraduate education was at Carnegie Mellon, and he earned his MBA from Wharton, and despite that education, he's been very successful. I want to thank both of you for being willing to talk to us here at SIEPR. Thank you.
I think I might as well just sit here for the remainder of the session here. As much more comfortable than standing over there over a lectern. But John, thanks so much for those kind words. We've known each other, as you can imagine, a long time. In '92, we became the Schwab Professor of Economics, which that's how I got through economics, you know, just name. No, I graduated actually a few years before that. But John, we've been great friends ever since, and have been thrilled to be a part of SIEPR from the very beginning. I can't remember the first time you asked me for money for SIEPR, but I was one of the early investors. I do know that, and been a happy investor ever since. You know, it's a real pleasure to be here and to speak about some things that are really important, I think, in the landscape of investing. But I want to make some attributions before I go into it. Really, it was Bill Sharp, who all of you know, and I'm sure is probably presented here, when he gave me the idea that in terms of asset allocation, it sort of created 90% of the eventual outcome of what if you're going to be in equities, you're going to get an equity outcome. If you're in bonds, you're going to get a bond outcome, or if you're in cash. It was sort of a simple notion that most of us didn't really realize at the time, and that's got me really curious about indexing and so forth. So John, I went to John in, I think it was '92 that you did the study for us. He engaged one of his, I don't think you paid him a dime, this guy Dixon, who was as a master's student, and I guess he got his PhD, and ended up going on to Vanguard, very successful professor, or not professor, executive at Vanguard. But the study was about, and you had the computers, I don't know where you got all the information, but what would happen with a mutual fund, or mutual funds over a period of time, over 10 years, and we did 10 years, I think, and 30 years. If they, and we took a look at S&P 500, the Vanguard 500, and about 50 or 60 other funds. And we looked at it over those time periods, and all of a sudden, these people who invested at the mean, meaning S&P 500 returns were mean returns. It was the average returns of stocks. And some funds did extraordinarily well, and some funds did not. But over a period of 10 years, what happened from a 50 percentile outcome of the S&P 500, at the end of 10 years, it got to 85% in terms of the percentile where it was in its ranking in terms of cumulative returns on an after-tax basis. After 30 years, they were well into the 90 percentile of performers. And of course, what we did is we tax affected all these funds, both as to capital gains and the dividends. It was a remarkable finding for me, and it probably was for you also to see that happen. But I just want to make that attribution known. A lot of this stuff is discussed in this thing, which Tobin actually, and I think, Heather, you also were a part of this thing. Heather Bach is my new chief of staff. She's sitting here right in front, next to John. That's what happened. We promote these guys and gals right onto big things. And Tobin runs our robo-advisor. So. But I brought him along to help me in the conversation that we're going to have in a few moments here. So, John, thank you for helping me, and Dr. Bill, and some of the ideas that they had presented to me many, many years ago, 25 years ago. So we have gone into, in the last 10 or 15 years, I was going to make one other mention about John Gunn and about other people in the private equity world and traditional funds, active managed funds. They are really an important part of our society. And I've been an investor and a participant in all of those things. Venture capital, private equity, they're all crucially important. I think what we're going to talk about in terms of indexing, I think it's really appropriate for 401ks. I think it's really appropriate for people that are 60, 65 plus in the retirement world. Indexing is really a crucially important thing to have in your portfolio or think about. But I love we need venture capital, we need innovation, we need all those things that are very essential. But when you get to a point where your horizon of investing may be reduced from what it was when you were 30, now you're 65 or 70, your horizon has changed to some degree, although we're living longer. But thank you, John, for what Dodge & Cox has done. He happens to be one of our largest shareholders. That's public information. I just want to make sure your guys know that.
We haven't sold it.
Yeah, I know that. And don't sell any. So today's conversation is about indexing. And I was talking to John a little bit about what would be the subject, how would we pose this thing in terms of discussion. And I have made the argument that indexing is not a passive kind of thing it's not really passive. And it's a terrible word. It really demeans the word of what we do in indexing. And there are very kind of indexes, but to start off with, the most popular, of course, is indexing based upon the capitalization value of a company. And so Apple being, I guess, is still the highest in terms of capital valuation. And of course, you take the market price times their shares outstanding. That's how you create the market cap. And so I, back 22 years ago, started this fund called the Schwab 1000. And out of it, I wanted to put some improvements in the thing. And one was that we wanted to make sure that we were very tax efficient, given the study we had just done. We want to make sure that we didn't create a lot of capital gains for people along the way. So we made sure that we did tax planning, tax affecting of the thing, and tax harvesting. So, which means when the market goes down, you sell a bunch of your losers, take the capital loss, and then you buy something new, or you then also sell some of your winners, so you offset the two, so the investor doesn't have to pay the taxes that we've created. So it's pretty important to look at a fund in terms of whether or not they do any tax affecting. The Schwab 1000 does and has done it, and for 22 years we've had a 9.4% return compounded for all these years. It's sort of a no-brainer, but in our case, instead of the S&P, has a committee that they have who picks stocks that go into the 500. So when something falls out of the 500, they have a committee that picks the new ones to go back into create the final number of 500. Although, and I don't know exactly how they do it. In our case, it's much more disciplined in the sense that we have no committee. We just take the capitalization of each company that's publicly traded, and we go from top one to the number 1,000, and that would go into the new year, and the top, usually it might be 4 to 5%, 40 or 50 companies would go out, and 40 or 50 companies would come in. And so you look at the composition of these funds, they change. In our case, we change every year. So it's fairly dynamic in that respect.
Yeah, and I think that's an important point. And when we've talked about indexing, you made the point initially. I mean, first, it's a great way for investors to get diversification, but the term passive does a disservice because I think you've said investing sort of in and of itself is an active thing. It's an act of optimism, and investors don't want to feel passive. And being able to talk about how the index changes over time, so 4 or 5% a year. If you look at the Schwab 1000 from when it started to today, no surprise, information technology has pretty much doubled in its size of it as all the great companies around here and elsewhere have grown. I think that point that you make around passive.
22 years ago it was fifth place in terms of that sector being in the fund. Well, today it's number one. So the rotation that goes on in index funds, generally speaking, there is lots of rotation. It has to be that way. And one of the major cases, I would say it's not really passive. There's a very active component to index funds as such. And then depending on the style of fund, there are new funds, which we can talk about a little bit later, about fundamental index funds. But there are many other benefits of index investing, frankly. It's that diversification component you talk about. It's the very inexpensive amount of operating expenses, and we've done lots of studies about that to see, you know, you look at a mutual fund that would have a 90%, 9/10 of 1% management fee, or let's say on average 1%, over a 20-year period of time, it can be a huge portion of your ultimate gain. That differential between 90 basis points, or in some cases, some index funds are as low as 4/10 of 1%.
Yeah.
Really low.
Absolutely.
It happens to be done by Schwab.
But we have
But,
some of the lowest
on
cost
average,
index funds.
Vanguard would probably be, what, 10
10 basis
10 or
points.
15 basis points,
Yep.
something like that.
You know,
And the Schwab 1000 I mentioned actually is higher on that, and we haven't lowered it. We should, one of these days, lower it. It's 30 basis points. So it's relatively high in the index world as such, just a disclosure there.
you know, I think one of the other interesting points that was made in here and that you talk about a lot is, you know, indexing, indexing has grown a lot. You know, it's grown from very small to 15% of all assets and a much bigger share of
Mutual fund assets.
and a bigger share, of assets. But many investors still try to do it on their own, and there's plenty of evidence to show that they make a lot of the wrong decisions.
I think the thing that Tobin is referring to, and probably the biggest mistake that all investors make, on average, people hold a mutual fund 4 years. 4 years, oh my goodness. It's just, it has no opportunity to grow or to participate with whatever the company is doing or the companies are doing. And you got to be thinking like Warren Buffett does. It's a lifetime. Once you go into a company, if it stops growing, okay, you might get out of it, but otherwise you hang on to it for the rest of your life, essentially. And long-term investing, as we all know, has been the way that people ride, both in controlling your emotion. When markets go down, nobody likes to hang on to stocks when they're down and going down further. But you have to learn how to do that.
Yeah, I mean, let me ask this. I mean, when we look at that data of the average fund investor holds it for 4 years, and then you look at how they perform against an index, they often lag by a couple percentage points a year. How do we convince people that getting market performance is pretty good?
Yeah, that's really...
I'm trying to get some help for my business. Right?
Yeah. I think a lot of people, frankly, don't really understand why they invest. And some of the most simple concepts, you invest in stocks because it's probably the only instrument that I know that grows. Now, some of you are in real estate, I know that. There's a building out here I'm pointing to right now that has never changed one iota in 100 years. It was built there in Cena Hall, I think in 1909 or something like that. It's never changed. Now, they've sort of refurbished some of the inside, but it hasn't grown. Now, looking over here, Apple computer, guess what it's done? It grows and grows and grows and grows. More customers, more services, more products, more things. Real estate doesn't do that. Commodities don't do that. Very few things grow other than equities. And so people sort of think of equities as some kind of instrument that ups and downs and so forth. But if you really want to maximize your values, long-term values, you got to hang on to it for a long, long time. And that's the beauty of index funds, in my view. You're capable of holding it in an indefinite period of time because automatically you're changing, you're upgrading that portfolio every year. You have very low management fees. Something's happening all the time, and that's wonderful. You're avoiding taxation. That's wonderful, particularly if you live in the state of California. Avoiding taxation, and that's why Warren Buffett is so wealthy. He never sold a thing, and that's why teaching people, whether it's 401k or just hang on. And it's very difficult as a human investor to do that because you, as I said, when markets are down or against you, you hate it, you blame yourself as down, but
Yeah.
it's really over the long term.
That's one of the hardest things we do is
So-
try to get investors to stay invested.
So Tobin, part of this conversation, has a few questions he was going to ask me, and I was going to try to answer them. If I don't have the answers, he has the answers, because he's now the expert of our whole area of indexing in this wonderful new product called Schwab Intelligent Portfolios.
Sure. Well, and I think it's just,
He's the president of it now.
I think to your point, John, it's just an evolution of how Schwab has tried to help investors in time. It's able to take more indexes to build a better diversified portfolio for individuals to try to help them stay invested and get invested and get advice. And actually, one of the things that is in the news some and that I know that you've been thinking about for a long time is fundamental indexing. We use that in our portfolios. But I know you've been you've spoken about this concept with Rob Arnott for a long time. I'm curious to get sort of some of the history and perspective on that. I mean, it's a different way to build an index. It's not market cap weighted, it's sales weighted or earnings weighted.
It's something I think every investor needs to look at. It's the next version of indexing called fundamental indexing. And Robert Arnott did an incredible, he's an economist. I think most economists probably know of him. But he did a lot of research, backtracking on fundamental indexing. And what that means is that he ranks stocks based upon a couple of components. I think revenue, book value, net income, a couple of other important things, and as opposed to just market capitalization. With market capitalization, it's the market that sort of determines the value of the index. In his case, it's the weighting is done by a combination of these 4 or 5 factors. And lo and behold, the performance has been incredibly good. Somewhere between 50 and 150 basis points better than the S&P. Now, we're looking at it. I can't say definitive. You have back testing going back, way back, but I would not want to rely on back testing. That's a fool's game sometimes. You want to see what it really does, and he's been doing it for the last 10 years, since 2005, I guess.
2005, yep.
And it's something to really track, is the fundamental indexing, but I think it's going to be another version of a better version of even the Schwab 1000, and it'll reduce its volatility, where, you know, the S&P 500 is now, Apple represents maybe 4% of the equity of the fund. And so if Apple or any of the other hot stocks now, like remember 2000, year 2000, Cisco represented a huge sum of the index, and Yahoo was there, and
Yeah, we were looking, AOL was worth
AOL
$220 billion.
$225 a share, and they just sold the company last week or a couple weeks ago to Verizon.
From $220 billion to $4 billion,
Yeah.
right? So it
That
happens.
was an adjustment.
It happens.
That was a major adjustment. So one of the values, the indexing doesn't let a company get so far out from the others in terms of its appreciation. It keeps it within the reason based upon these more fundamental valuations, revenues and things that you can point to, as opposed to simply capitalization. So my preference is looking ahead is to watch that and track that and maybe be a small investor in that area before you become a bigger investor.
Yeah, and it is something we use because, like you said, it hopefully helps moderate volatility. It doesn't have the as high at the highs and the low at the lows. And we know that for most investors, having them not act on their emotions when the market starts to dip, having to cushion that blow a little bit matters quite a bit.
So you had some questions there you were going to try to...
We've hit a lot of them.
I thought about what we're going to talk about
Yeah.
here, and I mean, there's only so many things you can say about passive investing, so, but it is not passive investing. It's very active. And
Yeah. You know, I think one of the things that I think is interesting, because we have hit a lot of them, we've talked about how companies are built to grow and why indexing is a great way to diversify. I think we've seen the trend of indexing growing. There have been many contributors to it. ETFs are one contributor, sort of awareness of indexing, but it's still 15% of assets. It's still not that large. So how do you see the trend evolving, and what do you think will happen for investors?
Well, ETFs is another version of, and I use them quite a bit. You use them a lot in the robo because they're lower OERs, even lower than index funds themselves. The fact that they're 99% of the time liquid, there's a 1% factor you got to worry about in times of high volatility when everybody wants to leave the door at the same time. It gets crowded and liquidity is not there to take care of it, but usually works itself out after a couple of hours of trading. But just fundamentally running an ETF that is, let's say it's a S&P 500 ETF, which I think we don't have one of those. We handle 5,000 different funds at Schwab, and so you can get any of the funds, but we don't personally manage.
We have a large cap ETF, but I don't believe it's an S&P 500.
Yeah. But let's take that for an example, an S&P 500. It has certainly a lot of the advantage. I've forgotten the point I was trying to make. Actually.
Well, I think so there's a couple of advantages we always talk about. You always talk about with ETFs is there's great transparency into them. They are tradable through the day, which people like.
The point was,
and there's tax
lower
efficiency.
cost of operating. If you've ever run a mutual fund before, and we have, I know John has, it's a very expensive process. You've got an outside board of directors. They have separate counsel. They meet quarterly or more often than that. There's a lot of overhead. ETF is, yes, it does have a board, but it's a very simplified thing. The reporting requirements are there. They're very important, but they're much more efficient at it than a traditional mutual fund. And there's lots of other efficiencies that go into running an ETF that funds don't have. Therefore, they end up being substantially lower management fees. And that's crucially important to your ultimate outcome if you're holding these things for 10 or 15 years.
Fees make a difference.
Yeah.
Chuck, if I look at our questions, we've talked a little bit about all the major topics that you were interested in on indexing. I know the audience here probably has plenty of other questions for you. And I think, Dr. Chauvin was going to come up and let the audience ask some questions.
So one thing I would note, remember I mentioned that Chuck was about integrity. So when was the last time a stockbroker told you that people trade too much? So you just heard that. And I don't think too many others would have done that. I was kind of wondering, for both of you, you have 9 million clients. And I wonder what you thought their biggest mistakes were. One candidate that I had was that they're under-diversified. I think a lot of your clients would have 1 or 2 stocks in their account.
Yeah, absolutely.
Yeah, that's absolutely one. You'll see if you listen to or watch our clients come in, listen to them on the phones.
John, it's okay if they're the right 2 stocks. But that's the probability of that for the average person is impossible.
Yeah.
They can't do it. And that's why, in my thinking, I've moved more and more over the years to something that's around indexing and having massive diversification. Unless I'm a pro in the world of investing, it is just a fool's game, frankly, to try to pick those 2.
Absolutely.
And why not?
In fact, frequently, the most egregious mistake is that you find somebody with 1 or 2 stocks, and one of them is their employer.
Yeah.
And they've already got a lot riding on the success of their employer, so doubling down on their employer stock is a big mistake.
I remember a lady came and sort of cried on my shoulder in one of our New York offices. Said, I've got Enron. It's one of my 2 great stocks, and then no longer it's great. And I said, I own Enron. It was in the Schwab 1000. I own Enron. It was 0.5%. I lost the same percentage you did. I lost 100% of Enron, but mine was only 0.5%. I would suggest, Adam, you look at these things.
So what about another feature of most investors is they have a home country bias. That is, Americans invest in American stocks, Chileans invest in Chilean stocks. It seems to be a global phenomenon to, I don't know if it's language or what, but they tend to be that way.
You know, it is. It's one of the things we've tried to build with our intelligent portfolios is a globally diversified portfolio. But it is a question we get from clients of, you know, emerging markets didn't do too well in sort of through the summer, and I was listening to a call come in, and the client said, well, why don't you just buy that emerging markets later? Why do you have to hold it now? I said, well, for a diversified portfolio, you need the broad range. It's you know, it's the equivalent of the Schwab 1000, but for the world.
Well, there's another answer, too. I don't know anybody. I've spent 40 years of trying to pick the bottoms. I've never picked a bottom ever. I mean, I've been close a couple times, but I've been many more times than that haven't picked the bottom.
Yeah.
And then, or picked the top. You simply aren't
Can't do it.
capable of making that happen.
And that's why you were saying buy and hold is really the...
It's really the only way to really maximize because of taxes, because of operating expenses, and go on down the line. And so
listen, it's time. John, you're in this business.
Are you developing a lot of customers overseas? Yeah.
John, in our case, no, we are not. We have an office in Hong Kong and one in London, and most of them are expatriates that use our facility. I think we have some in China, for instance, that come in, and we'd like to expand there, but there are regulations that happen in these countries that really are incompatible with how Schwab functions. And, you know, we have money market funds, for instance, and some communities, they don't permit that, or you've got to have a banking license, or use, you know, it's different ways. They try to protect their banking world there, generally speaking. So we're mostly for Americans.
Dixon.
There are a lot of young people here in the Valley that, through no fault of their own, have an excessive amount of their wealth concentrated in these positions that you just referred to. So how can you be helpful to them and their families? When, I mean, you have to abide by all the, you know, the constraints that are placed on them.
Yeah.
But, I think that's a really important issue.
It's a
Of your
huge
perspectives.
issue, John, and we certainly have services to corporations and so forth, and we encourage employees in their 401k to have these index funds and ETFs and so forth. And we try to get them out of the concentration, but there's no substitute for diversifying away from your concentration. And unfortunately, then you've got to pay the taxes. And that's a huge cut now in California, and it's really a terrible tragedy for employees, in my view, is they changed the taxes on stock options to such a high level now. If you hold a stock option for 10 years, you still pay current income tax and of course, capital gains tax on top of it. It's a terrible incentive.
Yes.
Hi, I'm a recent investor in fundamental indexing funds, but that's because I'm a recent investor in Schwab Intelligent Portfolios. I could probably find this out on the internet, but I'm interested in how often do those portfolios rebalance, and how do they trade off the benefits of the fundamental rebalancing versus tax considerations?
So the fundamental funds themselves are, much like other index funds, they're analyzed annually and rebalanced. Schwab Intelligent Portfolios has sort of set guidelines for asset allocation and makes the trades when your individual portfolio drifts past that. And as we built the portfolios, we did a lot of analysis of how much should we allow a particular asset class to drift for that particular question. You don't want to be trading on a monthly basis and rebalancing because it creates a lot of tax consequences. And so they're built to sort of rebalance in a normal year 1 to 2 times a year. But there are years that are abnormal. You know, in 2008, 2009, it would have been rebalancing frequently. And we spoke before the meeting, you probably saw a little bit of rebalancing and tax loss harvesting in August, as many people did. But it is trying to find that balance of the benefit of rebalancing in the long run versus the potential tax drag of gains.
So how often do you guys rebalance?
How often? We look to rebalance every single day based on your individual positions, but we would expect your portfolio would rebalance a couple times a year. But it's dependent on how far off your target allocation your individual portfolio drifts.
I remember back in that study that Chuck helped finance in 1992, Joel Dixon and I looked at a S&P 500 fund, which allowed a little tracking error. And we could run that fund for 20 years and never realize any taxable distributions, and any capital gains. So you can do a lot with this tax harvesting in terms of postponing at the very least. It's just timing, but postponing is a good thing if the person you're postponing is the IRS.
Tell us about the support you give to very young people in starting portfolios. I've sent a number of my grandchildren and various other young people in because I understand, rightly or wrongly, that Schwab people will talk to them and give them advice and get them started in the area here. How much of that can you afford to do, and what's going too far in making individual investment counselors?
You want to take that question?
Sure. Well, you know, we certainly...
Menlo Park has a wonderful office, let me tell you.
They do. Well, we certainly, anyone who walks into a branch, we help them think about their portfolios. And in fact, some of these more automated products help us serve a wider range of clients who maybe don't have as many assets or maybe prefer to get a little bit of help in the branch and then get started online. But you know, we've got folks on the phone 24/7 in 330 or 40 branches around the country, including the very nice one in Menlo Park. And anybody who comes in, we're happy to help them and help them get started. I mean, we build relationships for the long term. And so...
I should say, as a company, about 15 years ago, I decided there was no future really in discount brokerage as such. We're really a relationship company, which you probably haven't, our advertising maybe hasn't pierced that veil yet, but we really are now a relationship company, fundamentally. We have many people who are active traders and want to do it on their own, that's fine. We make a lot of money off those people, and I keep saying to them, stick with a good investment, but they don't want to, they want to trade. They have fun doing it. For most of us, we want to have a portfolio that we can hang on to for a long period of time, and when they get out of whack, we'd like to have it brought back to some sense, and that's what our financial consultants will help you do if that's your kind of approach. But just go into the Schwab Menlo Park office, which is the closest one to here.
You know, I was going to mention, you know, Chuck mentioned that expenses on these funds vary, and I think he said that the Schwab has an ETF which is 0.4%. He actually meant 0.04%.
Yeah.
Just to, it's even cheaper than he suggested. And so that's been a remarkable change.
Make no money out of that. It's a loss leader.
But it used to be that most mutual funds were charging of the order of 100 basis points, in other words, 1% a year. This fund charges 1% every 25 years. So this has been an area where there's been negative inflation. If you're a smart investor, you can now get in the market for quite a bit less than you could 20, 30, 40 years ago.
John, you are a wonderful straight man. So because of those low costs and a few other things, ETFs have become the playground of a lot of algorithms. high-frequency traders and so on. How do you feel about that? We've had, there's a wonderful background here of talking about individual investors, but the ETFs have become used for other reasons. What are your thoughts about that? 6 weeks ago, there
Yeah.
was no price for that Schwab ETF
Well,
at one moment.
we're well aware. I think we know that some work is going on to look into the ETF markets to see what went wrong and why they didn't function properly. And we think they're great vehicles for long-term investors. If you're buying and holding for the long run, sort of a 1 hour disruption isn't a problem, but it could be worrying, understand.
If you had to sell on that day,
Yeah.
it'd be a big problem.
And I think
I would never recommend you sell on that kind of a day,
and
really.
And in fact, for the large volume of trading that we do, we looked at the markets and said, it's automated to get ready to go to market, but we ultimately said, let's hold off until we can understand what's happening in the markets. But if you're holding for the long run, the underlying securities are there, they're being held in a trust bank for you if you hold the ETF, the underlying stocks, and it's a great vehicle, low cost, and so we do think it's still very good for investors.
Yeah, I would have to say ETFs, it's not unique to ETFs that there will be and has been liquidity issues. U.S. government bonds have those issues on an occasion when everybody wants to buy or a bunch want to sell at one time, creates those momentary periods of illiquidity and prices get kind of goofy at the time. So you have to be knowledgeable. That's why Tobin does what he does do. Smart guy.
Data and the predictive elements to see the signals, how those companies are doing, right? And I know you rebalance,
Yeah.
right? Let's just take China. What happened in China? Let's take Alibaba, right? It hit $50, right? We know it's going to come back eventually, right? All right, but leveraging the technology and the big data elements to maneuver some of the remixing.
So for the product I manage, we've built strategic allocations for the long run. So we're not making tactical changes based on signals. Schwab does have other products that, Windhaven, for example, that looks for opportunities in the market, but it's not something we're doing with this particular product.
So we had, John Chauvin has done a lot of interesting work over the years about how people don't optimize their claiming of Social Security benefits. Mm-hmm. So basically people claim much earlier than they should. They ought to wait, and the gain in present value is much greater if they can hold off, but for whatever reason people take it much sooner. Are there analogous types of low-hanging fruit for investors at that stage of life? We talked about people not holding on long enough, let's say when they're middle-aged, or not being sufficiently diversified. Are there mistakes people make systematically, whether it's, I don't know, annuitization, or what are the exact things you would point to? But the mistakes for Social Security are gigantic, and I wonder if there's anything.
Same thing with 401k. Most employees have a 401k, and young kids trying to make a decision at 25 or 30, they got lots of demands on their income. And consequently, they don't maximize. There's that free money component that they get from the companies matching. People don't even make that happen. That's an enormous mistake, because then you look back or forward 20 years, and it's just a huge loss to them in terms of opportunity for them. So we try to help companies coach their employees on the right kind of decisions to maximize their contributions.
The employees often leave matching money on the table. That's clearly a mistake. If your employer is willing to match your contributions to a 401k, I don't even care what the investment vehicle is, you should take it.
Take it.
Secondly, I think when people leave their employer, they often roll over their 401k into an IRA, and they may not be careful about the expense charges embedded in that IRA. And by definition, when you're retirement savings, you're in it for 20 years, 30 years, 40 years. So the difference between 100 basis points and 40 basis points is huge. It's 60.6% per year for 30 years. It makes a lot of difference. So I think, and some financial advisors, there's a big controversy about this right now, but are subject to what is called conflicted advice. And so you want to be very careful when you roll over.
John, there's some lady back here that's...
Yeah, there's been a lot of talk about tax efficiency in some of these passive funds. We've been through a 6-year period of time of a bull market where maybe the tax efficiency hasn't been tested from a redemption perspective. And I'm wondering how that plays out when your ability to hold cash isn't necessarily there. So is the tax efficiency really there in a bear market when you have redemptions and very little cash?
That's for you.
Sure. Well, when as we think about ETFs, different than traditional mutual funds, there are just greater tax efficiencies in how they're built and how shares are created and redeemed. And so, as you know, we've looked at them for the history they've been there. They've worked quite well. And actually, even as I think about mutual funds like the Schwab 1000, which and you managed for you've always managed for tax efficiency from 91 to, I forget how long the run was, 16, 17 years. It never had capital gains as a mutual fund. So
It's had some recently.
it's had some recently in, I think, the bull market, in fact.
Yeah.
But they've been managed.
Lousy bull market the last 6 years. We had to pay taxes.
I mean, as we look at them, we still are encouraged by the tax efficiency that's there.
Pitch.
This is not a question, but it's a brief comment. There was another era when the names were the leaders of big industries like the steel industry and the oil, Rockefeller, and the founder of Bethlehem Steel was Charles Schwab. So not when I first met Chuck, but a few years ago, I said, are you any relation to Charles Schwab? He said, when I was a kid, I used to say maybe I was, but I don't have to do that anymore.
It's true. I wish I had been, kept looking for inheritances. And that Charles Michael Schwab was his name. He died a pauper in 1937, the year I was born. Actually, he had no kids. There was no way I could have been a relative of his. I had to do it on my own, I guess.
So I'm intrigued by your view of fundamental indexing. And I saw recently that the White House issued an ecosystem services announcement that federal contractors and federal departments will have to look at their ecosystem services footprint. So I'm looking at sort of fundamental index version 2.0 and how you're going to talk to millennials about sustainability in their life cycle.
Well, part of the answer is what Tobin is doing with our Schwab Intelligent Portfolio. You have fundamentals.
We have fundamentals in there, and we've certainly had, and you're asking sort of about sustainability and sustainable investing too, right? And that's a question we've talked about at Schwab quite a bit and try to see where the trend is going and where the demand will be. We certainly hear a lot that millennials want that sort of product. Can't say we've figured it out yet, but we do know that there's a lot of interest from folks.
Yeah, what would be the composition of, you have a lot of millennials in.
We do have a lot of millennials in our product, and we actually think there'd be a lot of interest if we could find a way to have a sustainable version that was, if you care a lot about the environment or whatnot. We have a lot who are already attracted to this sort of investing, sort of technology enabled, but it's an interesting topic.
George Scalise over here.
This is a little bit outside of the conversation, but I think it relates. The idea of the Fed raising the interest rate here one of these days. And what is going to happen? Is it going to be as tumultuous as some people think, or it's just another day in the business world? How do you see this thing? What are your thoughts on it?
Well, I think won't be tumultuous, particularly the way they'll come out and say, we're doing it once, maybe in your lifetime. And the next time might be next year or after the elections, something like that. That's about it. I mean, we have a very dovish Federal Reserve, and I think they've done, I think they've had some bad judgment about that. My view, capitalist society we are, we've got to have free markets, and that includes interest rates, because the misallocation of resources going on now, I think, is humongous. And that's why we have a 1% growth rate in the economy, or 1.5%. Little companies aren't getting the appropriate credit consideration from banks. Those little banks have been really hurt by Dodd-Frank and all that stuff, that over-regulation. So I think if they do raise it 1/4 point this year, which some people speculate, I don't think it's possible, but if it did happen, I don't think it'll be a big deal. I think it's already baked into the confusing conversation. And then we're all confused by it, for sure. Mm-hmm. But what's happened, really, when you look at what the Fed has done, we had a crisis, they worked well in the crisis. And over the last ensuing 6 years, we got out of the crisis, and what's happened is the federal government's really benefited. They borrow at nothing. The seniors of our nation have been really harmed dramatically. The people who saved CDs, bank accounts, so on and so forth, insurance policies, have really been put on the party for the government. So it was a huge wealth transfer, went from seniors to the government. And meanwhile, you look at I don't know, John, you want to talk about this, but the turnover of money, the velocity of money is like,
it's really slow.
Dead man. It has been dead, and that's what's happened to our economy. It's just nothing working really well. And the Fed does not have the engine, or they can't make it happen. They got to turn it back over to the American enterprise system to do it.
One thing George knows is even though ultra-safe interest rates are low, credit spreads are very wide right now. So if you're a company, you know, a triple B company, a single A company, interest rates aren't that low. I mean, there's a big difference between what a triple B bond or a single A bond pays relative to what the U.S. government pays. And I think that's about as wide as it's been, except for maybe the worst part of the Great Recession.
Well, people don't want to take the risk either.
Exactly. It's probably a hangover from the Great Recession itself. People are very, very risk averse. Mm-hmm. One more, and then I think we'll call it.
This is another index ETF question. As these things proliferate, there's going to be a huge variety of fundamental factors that people use, so momentum or valuation. And I'm curious if you guys have studied what will inevitably be a huge range of options, and what, if you were going to recommend fundamental factors that you should look to, if you could give us some ideas on those, because I'm sure there'll be a bunch of poor fundamental factors as well as good fundamental factors.
Well, I call that alternative beta, I guess, or something like that. I'd be very cautious about some of the weird ones. I've gone back with Bob Arnett, and I looked at all his back testing for 20 years, and I thought he really had something there that was workable and consistent, something we could all feel comfortable with. Some of these other things they're going to be, I just don't think they're going to prove out, but we'll see in time.
Let me ask I said it'd be the last question, but let me ask another one. There are hundreds, if not thousands, of ETFs now. I mean, just an awful lot of them. Mm-hmm. Are there too many? I mean, to offer liquidity, you need some scale. And I'm not sure all these ETFs can deliver what they're
John, it's
promising.
the old marketplace, though. That's just wonderful. All these entrepreneurs put them out there, have done that, but they'll drift. Every
consolidate
year,
or
you're
leave.
dying off, and it's only the basic big ones,
Yeah.
500 or the Russells and some of our Schwab ones that are based on broad-based, consistent, have long track records and so forth. They're going to really make it. These others are fringe players. They're double leverage this and double leverage that. I mean, those are, again, fool's games in my view.
Well, he does tell you what he thinks. Thank you very much.